Brian, what is a structured note?
Yeah, a structured note is very complicated. I'll start with that. It's actually classified as a corporate bond, but it doesn't have the same attributes as a typical corporate bond. It is it's a debt security issued by a large financial institution, a bank usually. So the bank has these things that they put together, and in essence, they're for a period of time. And it is, as I mentioned, a corporate bonds by category. But they put it together for a period of time, and during that period of time, you will have particular equity type indexes. Might be the S&P, the Dow, the NASDAQ, and you will track those they will track that during that period of time, and they will give you a percentage of the gains of one of those indexes, the least of the three typically. On the downside, so they don't give you all of the gains of the equities. On the downside, they will absorb some of the loss. And so if there's a loss during that period of time, then they will absorb some of it. So it's kind of it's hard to explain how they do it. They use derivatives and all this other stuff I won't get into. But basically, somebody investing in a structured note is saying, well, generally I think stock markets are good, but when they're not good, I have some protection. I'm not protected like an annuity protects me. Annuities won't let me lose anything. I can lose a lot of money with a structured note if we have a terrible market, but they will absorb some of the loss. On the upside, I get a big percentage of a stock market index. So if markets are good, which more often than not they are, I would have a nice gain there too. So if you want max growth, put it into equities. Don't do a structured note. If you want max protection on the downside, put it in an annuity. This is somewhere kind of in between those two. Now there are some risks to, some detriments to anything, because initially when I heard about this, so I get gains in the market, and you absorb a bunch of the loss on the downside. That sounds pretty good. Well, they do have fees in them that are built into these things. It is put out by a bank. So let's say a huge bank that too big to fail kind of bank goes out of business, well then my structured note might lose its value. And so you have to make sure the banks you're with are really strong, and maybe you use multiple banks for this kind of thing. So there's all kinds of ways to create a structured note, but I just want to start getting into the conversation as to what they kind of are and what they are not.
Is there more opportunity for gain with a structured note than a bond?
Oh, absolutely. Bonds will lose money if you think rates are going to go up. All you'll get is a yield minus some of the principal value. And so some people might use them as a bond substitute. Again, annuities, they might have a floor of 0, which is better than a structured note. But they'll have maybe a ceiling as to how much they can make, or a lower percentage of an index. Whereas a structured note kind of can increase on both ends of that. You can have a higher upside and a lower downside than you can with a typical fixed index annuity. So they can play a role in a portfolio where you're saying, well, I like markets generally, but I'm kind of nervous about maybe the downside. I'm not really excited about bonds because I think interest rates are going up. You might have that as part of your solution on your asset diversification. That'd be one of the positives. It's just a diversification tool using all the other tools. I mean, wouldn't it be great if I was looking at my portfolio and I had real estate and equities and life insurance and annuities and structured notes and REITs and DSTs, and all these different things can interplay depending on the person. Maybe an important thing to have in your portfolio.
Brian, thanks for telling us more about structured notes.